Welcome everyone, and thank you for joining us in this session on corporate tax in the UAE. Actually, what is start of a Friday morning with around 700 attendees on this webinar. We are very excited that you have joined us this morning. For those of you who do not know me, my name is Wasim Shaheen, a tax partner at KPMG, leading the corporate tax department. With me today is a team of directors and specialists in this field. Starting with the ladies, I have with me Eli Abdali, Estina Delavan, Ramya Ayer, and Neha Jain, and the gentlemen Peter Skurrell and Ankit Martyr. And I thank them all for taking the time to share their knowledge in this domain. Actually, a little bit of housekeeping matters. We have the recording that will be shared with you after the webinar. You can ask any question and put it on the Q&A panel on the right, and we will be more than happy to answer you all your questions at the end individually by our tax team. A feedback about the webinar will be appreciated. Now, honestly speaking, it's not common to be living and working in a country where a new tax law is introduced. That's very exciting. We are privileged and excited that we are witnessing this in the UAE, and we are ready for the challenges and opportunities that this new law is bringing. This webinar is just the first of a series of sessions that we will unwrap the specifics of the law. Today's objective is to bring to your attention the key highlights and specific aspects that would be relevant to this audience. It is important to note that the published CT law, which came in 18 chapters and 170 articles, adopting the worldwide tax principle of taxation, is still very general and leaves a lot of details pending at this stage. As expected, a number of articles indicated that the details of their application shall be issued by a cabinet resolutions, ministerial decrees, or decisions. We expect a lot of clarification documents to be issued in due course from the Ministry of Finance and the Federal Tax Authority, either through executive regulations, FAQs, or other public policy publications. A very important matter to note is that the Ministry of Finance has embedded transfer pricing rules in the CT law itself, and hence businesses need to have a new mindset with respect to dealing with related parties, and this creates accounting and tax challenges that need to be navigated. It is also worth mentioning that the law has now been published in the Official Gazette and put into effect. The public consultation document issued by the Ministry of Finance in April this year should now be ignored and not be considered in new CT preparations, as it is not a legal document and does not have a legislative power. However, the Ministry of Finance has published 158 FAQs which help clarify certain matters of the law. On another note, though this webinar is not intended to cover and tackle BEPS Pillar 2, it's worth highlighting that the CT law, as expected, did not address the global minimum tax that may be applicable to multinational entities and its interplay with the CT in the UAE. As a recent development, the EU member states reached an agreement earlier this week to implement the Pillar 2 from the year 2024, and so the EU states are the first runners, and we expect the UAE to follow soon. And if so, the first year of application of the BEPS rules and the global minimum tax is likely to be 2024. The last point I would like to mention before I leave the floor for my colleagues is that the CT introduction and application cannot be looked at without considering its impact on the VAT treatment of your daily transactions. This is a very important matter to be addressed while performing CT impact assessments, which should also cover the impact on your people, processes, your organization, accounting treatments, financial statements preparations, transactions with various related parties, and ERP systems and functionality. There is a famous saying by Albert Einstein: the hardest thing in the world is to understand is income tax. I will hand over to Eli and to my colleagues, who will hopefully demonstrate that a variation to the theory is definitely possible. Eli, the floor is yours.
Thank you so much, Wasim. Good morning, everyone. So in this section, I will set the scene of the corporate tax law by walking you through different corporate tax elements with high-level comments only. My colleagues will provide the explanatory details of the relevant sections. So now let's kick off with the effective date of the law. The corporate tax law will be applicable for financial years starting on or after 1st of June 2023. So this would mean that for a company with a financial year ending 31st of December, the first year that CT law will be applicable is financial year 2024, with a corporate tax return filing and payment obligation 9 months after the financial year. There's a simple progressive tax rate table. The taxable income below 375,000 dirhams is not taxed. And for any taxable income exceeding this threshold, a flat rate of 9% is applied. This threshold has not been mentioned in the law and may be subject to change. So who is taxable? This will be all UAE incorporated and registered businesses, both in mainland and free zone, individuals with business activities in the UAE, as well as permanent establishment of foreign companies registered in the UAE. The fourth example that we would like to highlight here are the free zones. In this case, the free zones are subject to corporate tax and have not been exempt. The free zone entities will be able to benefit from the 0% taxation over their qualifying income, and the law also has clarified by now that non-qualifying income will be taxed at 9%. The CT law similarly provides a detailed list of companies that are considered exempt persons from corporate tax law. In addition to exemption and exempt persons, there are also certain type and categories of income that will be exempt. And an example of that is the participation exemption that would exempt dividend and capital gains from qualifying participations. We also mentioned the tax grouping. This tax grouping is a facility that allows group entities to elect to form a tax group for corporate tax purposes only and be considered as a single taxpayer with the obligation to only file one tax return and make one payment. Now, how will the tax calculation be, how will the tax calculation actually in this case, in this regard, be prepared? The starting point of the corporate tax liability will be the accounting net profit, as it is reported in the financial statement. Certain tax adjustments will need to be made. This to the net accounting profit, which would, for instance, mean that any income that is exempt under the participation exemption will be excluded from the accounting net profit. Another important example of an adjustment is the interest deduction restriction. This interest deduction restriction means that any interest in a specific year up to 30% of your earnings before interest, tax, depreciation, amortization, the so-called EBITDA, will be allowed, but any interest above that 30% threshold will be disallowed for deduction in that specific year. Any remaining interest expense can be carried forward to 10 years, for 10 years. Finally, the corporate tax law also caps the tax loss utilization to 75% of a taxable income in a specific year. Any remaining tax loss can be carried forward indefinitely. We mentioned a very important article here, and I will briefly kind of clarify this point, which is the withholding tax rules. Currently, there will be a withholding tax law provision which governs the cross-border payments for both related and non-related parties. This withholding tax rate, this source tax, currently has been set at 0%, but this may be increased under the cabinet decision in the future. Therefore, it is important to map any outbound payments, which could be services, royalty, dividends, or other passive income, to assess the applicability and availability of tax treaties in order to be prepared for the future changes, potential future changes. Transfer pricing rules, as mentioned, will be introduced, which will bring new obligations for transactions between related parties. And the final point and tax element is that the FTA will be the responsible authority to administer and enforce the corporate tax law. As a final remark, I would like to highlight that the CT law also has introduced or introduces general anti-avoidance tax rules to challenge mainly tax-driven transactions, but the scope and the interpretation of these rules needs to be clarified. Now I will hand over the floor to my colleague Neha to walk you through the taxable persons topic. Thank you.
Thank you, Ali, and good morning, everyone. We would now be talking about the very foundation of this tax law, which is the definition of taxable persons and their corresponding taxability. Ellie has already touched upon the fact that there are certain categories of exempt persons under the tax law. What we see on this slide is the two categories of taxable persons, which are residents and non-residents. The difference between these categories is important as both have different implications as far as the income on which taxes are to be applied. While the residents are taxable on their worldwide income, with an exception of natural persons who have a slight deviation in terms of what becomes taxable. In cases of non-residents, the taxability is limited to the extent of income which is considered as sourced or attributable to UAE. Going further, let's look at the categories of resident persons. If you can, yeah. The first one is an obvious one, which is a juridical person, which is incorporated in the UAE. A juridical person, as we all know, includes a limited liability company, a foundation, a joint stock company, among others. It also includes both categories of mainland and free zone entities. We would be discussing more about the taxation of free zone entities in the next section. The next category of resident is rather an interesting one. This is a foreign entity having its place of effective management in the UAE. Currently, the FAQs state that the poem is considered to exist where the key decision makers or the board of directors make any strategic decisions. This could clearly have a huge impact on UAE headquartered groups having operations in other countries if the decision making continues to be centralized in UAE. It is worth mentioning that the determination of poem has been a controversial topic globally and has been a subject matter of a lot of discussion even in UAE since the time the public consultation document was released. The last category of residents is of natural persons. Considering that UAE does not have a personal tax regime, this category is meant to cover the natural persons who are carrying out any kind of business or business activity in the UAE. An interesting observation here is that while the law seems to exclude independent consultants from the scope of taxation, freelancers could still be in scope if they carry out any of the specified business activities. With this, we move to our discussion on non-residents. And here we first see the first category is of permanent establishments. So if there are foreign entities which have a permanent establishment in the UAE, they would be subjected to tax on the income which is attributable to the permanent establishment in UAE. Now, the definition of a permanent establishment is largely based on the latest OECD guidelines, and it includes elements from the BEPS Action 7 report. It also includes a fixed place PE and an agency PE with a specific exclusion for preparatory or auxiliary activities. There is also an exclusion for an independent agent or an employee who is present in UAE for a temporary period or engaged in non-core activities of business. It may be important to note that while there is no service PE clause under the law, a service PE scenario may still be covered under the broader fixed place PE definition. The second category of non-residents is of foreign entities who earn any kind of UAE-sourced income. The definition of what constitutes UAE-sourced income is quite wide and also non-exhaustive. It includes income derived from activities, any kind of services performed, or assets located in the UAE. Now, the good news is that while the UAE-sourced income is taxable, it is currently subjected to a withholding tax of 0%, and therefore there would not be any real tax impact for foreign businesses having their source of income in UAE. However, if the withholding tax rate is changed in the future, businesses may need to consider its tax impact along with any corresponding tax treaty relief. The third category under non-residents is of foreign entities having any nexus in the UAE. Unfortunately, the term nexus has currently not been defined and is expected to be clarified by a cabinet decision. With this, I hand over to Ellie to talk through the hot topic, which is on free zone taxability.
Thank you, Neha. Indeed, so as mentioned, free zone persons are subject to corporate tax. The law introduces the concept of a qualifying free zone person, and such a qualifying free zone person will continue to benefit from the free zone tax incentive regime if certain cumulative conditions are met. So all of these conditions need to be met as listed here on the screen. I will highlight the two main conditions. First is the free zone person needs to maintain an adequate level of substance in the UAE. Although not specified what this would constitute, this will likely be in line with the existing economic substance regulation. Also, the free zone person needs to earn qualifying income. Similarly, there's no definition of what would constitute a qualifying income, and we will have to wait for the executive regulation and the minister decision on this. In case of a qualifying income, this will be subject to 0%. In case the free zone person earns non-qualifying income, that portion of the income will be subject to 9%. Pending clarifications, as mentioned, the qualifying income, what would constitute a qualifying income is the election to be taxable, irrevocable, as well as the implications of a free zone person earning mainland source income. Now, moving on to the next slide, there is a diagram to very briefly walk you through the setup of the free zone tax classification assessment. As mentioned, if the free zone person meets all the conditions, as mentioned before, the entity will be considered a qualifying free zone person. The next step is to assess if the income is qualifying or not. Qualifying income will be subject to 0%, and non-qualifying income will be subject to 9%. Now, this still does not mean that if any of these conditions are not met, that automatically the free zone person will be disqualified or will be basically rejected from the free zone tax incentive. we will have to wait for ministerial decision and the conditions set therein on whether the free zone person can still continue to be treated as a qualifying free zone person. If those conditions are met, then we're back at the left side of the chart and we'll have to again assess the nature of the income. Then moving on to the free zone entity treatment for certain UAE tax CT facilities, corporate tax facilities. The free zone person has been excluded from tax grouping. The free zone person cannot be considered part of a qualifying group for any intra-group transactions and the exemption that is available for such transactions. There is no possibility to transfer losses to and from a free zone person, as well as the business structuring lead. And just to give two illustrative examples, on the left side, you'll see an example where a UAE mainland parent owns more than 95% of the shares in two UAE entities. So based on the conditions, the UAE, these entities should be able to form a group. However, the tax group can only be formed between the UAE parent, the mainland parent company, and subsidiary A. Subsidiary B, as a free zone person, cannot be part of the tax group. Second example is an example of a transfer of loss. Subsidiary A and B both are mainland companies and are both held by a free zone person as the shareholder. The losses of company A can still be transferred to subsidiary B despite the free zone shareholding. In other words, for the assessment of transfer of loss, there's only a limitation on the entities that are directly involved in the transfer of loss transaction, and no restrictions on the shareholder. As you can see, there are still quite a lot of open points, so please feel free to raise your questions in the Q&A and we will address those separately. With this, I will pass on to my colleague Ankit.
Thank you, Ali. So while the UAE has introduced corporate tax, its intent to remain a competitive jurisdiction and attract foreign investment still is intact. And as we'll see through the analysis of the law, there are several instances and measures that have been put in place to retain their attractiveness. One such measure is in relation to treatment of certain income as being exempt. There are four categories of income that have been classified to be exempt. The first is dividends and profit distributions from a domestic source from within the UAE. The second is dividends and other income such as capital gains from participating interest, and we'll go into the definition of participating interest in a moment. The third is income from a foreign permanent establishment, be that a branch or similar extension of the parent company, and lastly, income from non-resident persons that operate in the international transportation sector. For the purposes of today, we'll be focusing on the first three. And before we get into the conditions, as a broader general condition, any expenses that are associated with incurring or generating exempt income will be disallowed in the calculation of taxable income. So moving to the conditions, for domestic source income, it is fairly straightforward. The income that is received should be from an entity that meets the condition of resident in the UAE. And as you will recall, the UAE has recently released regulations defining tax residency. The income can be in the form of dividends or profit distributions such as capital gains. Participating interest is a concept that is commonly applied in other jurisdictions. The first three conditions are fairly straightforward concepts. You have a shareholding test, which requires the taxable person to hold a minimum of 5% or more shares
in its investment. There's a holding period test requiring an uninterrupted period of 12 months or more. Is subject to tax test, which requires the underlying participation or investment to be subject to tax at an equal or greater rate than 9%. The last test, the qualifying asset test, requires the participation to hold at least 50% underlying participations to meet the participation exemption conditions if they were to be held directly by the taxable person. You see this type of concept coming, particularly where holding companies are interposed between the parent company and the underlying investments. It is also worth noting that on a positive note, there are substitute measures that have been introduced to address some of the uniqueness of the UAE, one of which is where investments of significant value do not meet the shareholding criteria. It may be possible for such investments to still qualify for the participation exemption, provided the acquisition value of such investments is higher or equal to the threshold that is set out in the cabinet resolution. So that's one substitute measure that has been introduced in lieu of the shareholding test. And with respect to free zones, as we have heard in the previous segment, there may be certain free zone entities that may be eligible for a 0% tax rate and therefore might on an ordinary course be failing the subject to tax test. But if these are pure holding companies, then the subject to tax test will be considered to be met. Lastly, with respect to foreign permanent establishments, an election can be made to exclude the financial results of such foreign establishments. The key criteria over here is that such income should be taxable in the jurisdiction of registration. It is also important to note that once an election has been made, it will be irrevocable and would apply to all foreign establishments of the taxable person. Just to illustrate some of the concepts, we have a typical structure. If we look at UAE A as the taxable person and its participation in OPCO A, which is a mainland UAE entity, it doesn't matter what the shareholding is, as long as OPCO A is a resident person and is distributing dividends or capital gains, such income is going to be qualified as exempt income. Moving on, in the case of OPCO B, we look at the participation exemption criteria. As long as the four tests are met, which in this case there would be by virtue of the shareholding test, the subject to tax test given Oman's tax rate, and assuming a holding period of more than 12 months, the first three conditions are met and you do not go for the fourth test since OPCO B does not have any underlying participations. The next example is, as mentioned, where the qualifying asset test is a prominent test that needs to be considered. Here, the criteria is that Holdco C, one should meet the subject to tax test on the basis that it's a pure Holdco company. And then with regards to its participation in OPCO C, you need to test whether UAE, if it were to hold OPCO C directly, would the participation exemption conditions apply, which in this instance would be the case because it holds directly, it would hold and meet the shareholding test. Oman as a jurisdiction would apply would qualify for the subject to tax test, the holding period test if met, and there being no other assets under OPCO C, and Holdco C only having OPCO C as a participating interest, the 50% criteria would have been met, and therefore the distributions through Holdco C would qualify for exempt income. Lastly, OPCO D, here we would look at the cabinet resolution to see if the shareholding test could be substituted by the acquisition value test. And in the case of branch, UK has a tax regime that is applicable to foreign branches, and on that basis, UAE could elect to exempt the income of the branch. Moving on, just very quickly to illustrate instances where the participation exemption tests can be failed. OPCO B, if it doesn't meet the shareholding test and the cost of acquisition is not in line with the ministerial decision, the participation exemption would not be met. Looking at another example, a more complex example where Holdco C holds multiple participations, the key, apart from the other test, the key test that needs to be seen is whether Holdco C has at least 50% of its participations meeting these conditions. And even if OPCO A meets the criteria, if OPCO B does not meet the criteria or by virtue of Bahrain not meeting the subject to tax test, or OPCO C does not meet the tax test by virtue of shareholding test, on a cumulative basis, only 1 out of 3 participations meet the participation exemption conditions, thus not satisfying the 50% qualifying asset threshold. The participation in Holdco C will not be eligible. Moving on, my colleague Istina will be talking about the next topic on transfer pricing.
Thank you, Ankit, and good morning, everyone. When we look at the transfer pricing rules under the UAE corporate tax, these are in line with the internationally accepted principles that are set forth in the OECD transfer pricing guidelines. Article 1 introduces or defines the market value, which is the price that could be agreed in an arm's length free market between persons that are not related parties. The arm's length principle is defined in Article 34. Basically, an arrangement between related parties would meet the arm's length standard if the results of the transaction are consistent with what would have been realized if the parties were not related. This arm's length principle applies to both domestic and cross-border transactions in the UAE. Article 34 introduces the transfer pricing methods. So there are 5 methods that are being introduced: the comparable uncontrolled price method, the resale price method, the cost plus method, the transactional net margin method, and the transactions profit split method. All of these are in line with the OECD transfer pricing guidelines. In case neither of these methods can be reasonably applied, the law would allow for the application of another transfer pricing method to the extent that it would lead to an arm's length result. The application of these methods may result in an arm's length range of financial results, subject to certain conditions that are expected to be published in a decision issued by the FTA. Transactions carried out between business lines of an exempt person should also be carried out in accordance with the arm's length principle. Also, transfers between taxpayers that are part of the same qualifying group should not give rise to any gain or loss for the purpose of determining the taxable income of those taxpayers. In the context of business restructurings, the assets and liabilities that are transferred, they should be transferred at the net book value so that neither a gain or a loss should arise. Article 35 introduces the concept or defines the concept of related parties. Individuals are considered related parties with their relatives up to the 4th degree of kinship. For juridical persons, any direct or indirect ownership interest of 50% or more in a business, as well as the ability to control that business, will be looked at for the purposes of identifying related parties. Control is defined in Article 35 as the ability to exercise 50% of more of voting rights to determine 50% of more of the composition of the board of directors, or the ability to determine significant influence or control over a business. The concept of connected persons is also introduced in Article 36, and a connected person is an owner of a taxpayer, a director, or an officer of a taxpayer, or a related party of these individuals. The law includes provisions covering payments made to connected person to be made at market value in order for those payments to be considered tax deductible. For the purpose of proving compliance with the arm's length principle, the transfer pricing methods that I mentioned earlier should apply. The law also introduces the concept of transfer pricing adjustments. In the event of adjustments imposed by a foreign tax authority which would impact a UAE entity, an application must be made to the FTA for a corresponding adjustment to provide the UAE entity with relief from double taxation. When it comes to domestic transactions, this type of application is not required. The transfer pricing rules in the UAE also cover documentation requirements. There is a transfer pricing disclosure that is required to be prepared by taxpayers. This disclosure should contain information about the transactions carried out by the taxpayer with its related parties and connected persons, and it should be filed with the FTA together with the tax returns within 9 months of the fiscal year end. A master file and a local file is also required to be prepared under a prescribed form, and it should be provided to the FTA within 30 days upon their request. The law also introduces advanced pricing agreement, and further guidance is expected with regards to the application for such an agreement. Further guidance is also required or expected with regards to the content for the master file and local file, as well as the threshold needed to be looked at for the purposes of preparing this type of documentation. What does this all mean? In a nutshell, it means that UAE businesses will need to abide by the arm's length principle when carrying out transactions with their related parties and connected persons, and they will also need to prepare contemporaneous transfer pricing documentation and keep it on their records. I will now pass on to my colleague Peter Schorel to discuss about the corporate tax implication for asset management businesses in the UAE.
Perfect. Thank you, Stina, and good morning, everyone. The corporate tax legislation contains several provisions that are relevant for the asset management industry, and particularly for investment funds and sovereign wealth funds, and I will briefly touch upon these. To start, there's a provision that provides that unincorporated limited partnerships are treated as tax transparent for corporate tax purposes, which means that the partnership itself is not subject to tax, but that its assets and income are allocated to the limited partners for tax purposes. The provision is relevant for investment funds, as funds are typically structured as such limited partnerships. So for those funds, it's not the fund itself that will be subject to corporate tax, but the income will be allocated to the limited partners, right? The UAE has taken a very sensible approach here, in my view, and it's also very similar to how other jurisdictions treat limited partners for corporate tax purposes. Now, for funds that are not structured as partnerships, but for instance as a corporation, those funds would not be considered tax transparent and therefore would be, in principle, subject to corporate tax. However, for these funds, the corporate tax legislation provides for an exemption, provided that they meet certain criteria. One of the criteria is that the fund or its manager is regulated by a regulatory authority here in the UAE, for instance, by the Securities and Commodity Authority or one of the financial authorities in the free zones, ADGM and the IFC. Another requirement for the exemption is in relation to how the fund is being marketed. In order to qualify for the exemption, the fund should be marketed to a sufficiently wide group of investors, or it should be listed on a stock exchange. The legislation does not provide how wide this group of investors should be, but we expect this group should be quite broad. The public consultation document that was released a few months ago by the Ministry of Finance had suggested that no group of 5 investors should hold the majority of fund participations. And I expect the exemption will have a similar requirement. For funds that do not meet these criteria and therefore would not qualify for the corporate tax exemption, they would in principle be subject to corporate tax. However, for funds that are located in free zones such as ADGM and DIFC, the actual impact of that may be limited. Like other free zone entities, these funds may qualify for a corporate tax rate of 0%, assuming, of course, that the fund meets all the relevant free zone criteria that we discussed earlier. So even if a fund is located in the free zone and does not qualify for the exemption, it would need to file a tax return, but it may not actually be paying corporate tax. So just to quickly summarize, corporate tax consequences for an investment fund will depend on its legal form. Funds that are not transparent may qualify for an exemption, and funds that are located in the free zone that do not meet the requirements for the exemption may qualify for the 0% corporate tax rate, provided that the conditions are met. Next slide, please. Yeah. There's also a specific provision in the corporate tax legislation for foreign investment funds, so funds that are set up outside the UAE. The provision provides that if a foreign fund has a UAE-based manager that makes investment decisions and concludes contracts on behalf of the fund, then these activities that the investment manager undertakes would not result in a permanent establishment for the foreign fund here in the UAE. So this is an exception to the general permanent establishment rule, and it's a very welcome provision as it provides certainty for foreign funds that and therefore make the UAE a much more attractive jurisdiction for fund managers. Do note that this exemption requires that the investment manager is regulated by a regulatory authority, and there's a couple of other requirements that need to be met. Next slide, please. There's also an exemption in the legislation for certain entities that are owned by the government, to the extent that these entities carry out activities that are mandated by the government. There will be a cabinet decision that will list the government entities that would qualify for this exemption, and we'll need to wait and see which entities would be on that list. But our expectation is that the list will include the UAE-based sovereign wealth funds. Also note that this exemption will only apply to the extent that these entities perform these government mandated activities. If the entity also performs other activities, business activities, then such activities would be subject to corporate tax. And in that case, the entity would need to maintain separate financial statements for those activities and determine the taxable income for those activities on an arm's length basis. Next slide, please. Lastly, there's also a specific exemption for SPVs or exempt that are being used by exempt investment funds and government entities. This exemption may be helpful because investment funds and sovereign wealth funds typically structure their investments through the use of SPVs. And if the investment fund and the sovereign wealth fund is exempt from corporate tax, so meet the requirements that we discussed earlier, the SPV may also qualify for an exemption. Pure holding companies should generally qualify for this exemption, but funds should really review whether applying for such an exemption would actually be beneficial, especially if the SPV holds foreign investments. Because if the SPV is exempt from corporate tax, it may no longer be entitled to tax treaty benefits, which may result that there is an overall more tax leakage in the investment structure as a result of the exemption. So the key takeaways, just to summarize, for investment funds and sovereign wealth funds is that they may qualify for corporate tax exemption, subject to meeting the conditions, and also their SPVs may qualify for an exemption, but it should be reviewed on a case-by-case basis whether such an exemption is beneficial, particularly if the SPV holds foreign investments. And if the SPV is not exempt, it will need to file a corporate tax return, and my colleague Ramia will address the compliance aspects of corporate tax in more detail. Ramia?
Thanks, Peter, and good morning, everyone. So I'm here to talk about some of the key aspects which have come up in the tax laws around compliances and administration activities. Now, the first step would be for a business to obtain a tax registration number. The form, manner, and the timeline is yet to be prescribed. So we need to watch out for more information on this space. In terms of transitional provisions, the opening balance sheet for corporate tax purposes for the first reportable period should be the closing balance sheet which has been prepared for the previous year, and this needs to be taking into consideration the arm's length principle. The law also provides for anti-abuse provisions. What that means is the tax authority is now going to watch out for the tax planning activities that are being undertaken by groups, and this should not be to obtain a corporate tax advantage, rather should have a commercial or economic or business reality to it. And the FTA now has the authority to make adjustments to counteract the CT advantage by either making a change or changing increasing the corporate tax liability. The law also provides for deregistration of activities now at the option of the entity, or the FTA would also have the option to deregister a business in case certain conditions have not been met by the taxable person. Moving on, I'll take you through the aspects around tax returns. So every taxable person or parent company on behalf of the tax group is required to pay taxes and file tax returns with the FTA, and this should be done no later than 9 months from the end of the reporting period. Now, in the case of a year ended 31st December 2024, the due date to file a tax return would be 30th September 2025. There are certain other provisions such as refunds, assessments, penalties, and fines for violations, which the law has deferred to the tax procedures law for further guidance. Now, documents, records are to be maintained by every taxpayer for 7 years. The contents of tax returns are also provided within the law. However, the form and manner in which the returns must be filed are yet to be clarified. Some of the aspects which will have to be included in the tax return are the tax period, details of the person, the taxable person, the tax to be paid, the taxable income, and tax loss relief or tax loss transferred that needs to be incorporated within the tax return. With this, I will pass it on back to Wasim, who is going to talk about the next steps and key considerations for businesses.
Thank you, Ramya. Thank you, team, for this very, very informative and technical session so far. As you can all notice, though the city law in the UAE is designed to incorporate best practices globally, the CIT is not a straightforward law, and it entails a lot of considerations to be taken into account. To name few for the sake of time, companies definitely need to analyze their legal structure, their entity and group structure. They need to see the interplay between the mainland and the free zone. This is a very, very hot topic in the UAE. And as Ali mentioned, and Niha, this free zone is yet to be detailed in a cabinet decree where all the transactions between the free zones and the mainland will be hopefully clarified by then. Businesses have to definitely look into the anti-avoidance rules. They have to look whether they need to maintain the ESR reporting after the introduction of the corporate tax after 1 June 2023 and 2024. They have to look at the grouping, and as you can notice from the presentation, you might have a VAT grouping, and you might have a CT grouping, and you might have also IFRS group consolidated requirements. So this complicates a little bit the compliance matters. You have to also look at the double taxation treaties, because as we understand from the application of the CT law, that the UAE will honor all the double taxation treaties that have been ratified by the UAE. You need to analyze the exemption, the participation exemptions more thoroughly. You have to look at definitely the carry forward of interest and expenses. You have to look at the various type of expenses, whether they are deductible or non-deductible. You have to look at the tax losses and what have you. Now, in respect of the next steps, how KPMG can work, I will try to make it very quick. KPMG can provide you a roadmap on CT, and we can tell you whether you have any gaps or you are fit for CT. We will help you in the tax assessment and planning phase, and then we can implement these gaps if they are in place, and if there is any need for any change in your corporate structure, any change in your reporting, data analysis, etc. And then later on, after the implementation of the law, and hopefully after 1 June 2023 and or the year 2024, for most of the companies in the UAE, we can help you definitely file your tax return, your TP documentations, and then God forbid go into a tax dispute resolution with the FTA. Now, in respect of time, we will have to end this session. I hope you have benefited from this webinar and that you have identified a lot of takeaways. Nevertheless, this is just a start, and we expect to conduct much more sessions in the future as a lot of developments in the UAE CT space. So please stay tuned. KPMG Tax Department is determined to help its clients in the best way possible in this CT journey. Thank you again for your time. Together for better.